Good afternoon, everyone. This is T3 Live Editor-in-Chief John Darsie here to bring the daily recap. So as I talked about this morning, it was a quad witching Friday, which oftentimes leads traders to get away from the desk a little bit. Sometimes you get peculiar action with quad witching. Happens 4 times a year. It's the third Friday of the month at the end of every quarter. So you had a lot of different options expiring, and as a result of that, you get some people driving stocks into areas of max pain based on open interest and things like that. Some people do some analysis on that and are able to target some potential ideas on days like this, but for the most part, I think a lot of traders try to take it slow. And then as I talked about, factor in the fact that you have March Madness. And the most important thing that happened today, to be honest with you, is that Duke lost to Mercer. Big upset in March Madness. Made me very happy, made my day. So the rest of the NCAA tournament is just gravy for me now after seeing Duke lose. But anyways, back to the market action. The S&Ps, as you might expect on a day like today, very whippy. We can go ahead and take a look at the chart as I talk about it. But as you can see, this morning we were strong, pushed a little bit higher. People were looking at a potential breakout to highs and talking about strength in the market, but we got a real nasty reversal. And as you can see over the last 4 days, they just sort of epitomize what we've seen in the market in 2014 in terms of being very indecisive, very choppy, not any commitment to either direction. We snapped back with an impressive 2-day snapback after there was no military escalation in Crimea, gave all that back on Fed Day. Yesterday erased all those losses from Fed Day, and then today put in a nasty reversal to go back to yesterday's low. We're still above the 21-day moving average, but a lot of cracks and warning signs starting to add up to the point where you almost can't ignore it. But then again, like I talked about this morning, the indices have just been so resilient that it's hard to really count them out despite the weakness that you see. Money continues to rotate. So, when one area falters, when leadership falters, other areas pick up the slack, and then they give time to they provide time for the leaders to get back on track and reassert their leadership. So we'll have to see what this evolves into next week. Now that we have quad witching out of the way, I think the market will have a little bit more freedom to do what it wants to do. And obviously you have the Fed tapering, you have the ongoing situation and back and forth between Russia and the United States regarding sanctions and things like that. You have some interesting crosswinds going on in China. Winds might be shifting where some laggards might start to take over, but you have a lot of interesting dynamics right now in the market, and things are acting in sort of a counterintuitive manner when you talk about trends based on macroeconomic factors. So it's just going to be very interesting to see how this develops, and the market can often be very irrational on a short-term time frame, but over the long term, your goal is to somehow harness some long-term rationality, if it exists anymore, and come up with some ideas that way. But some things that happened today. We had some extreme weakness in, as I've talked about, some leadership areas that have really started to weaken, and I'll go through some momentum areas first. And the 3D printers have been weakening for a significant period of time, but you just saw sort of some escalation to that weakness today. And we'll take a look at Triple D. We had a really weak earnings report a few days ago from XO&E, and that's done nothing but increase people's bearishness for this sector. Triple D, which has long been the leader in the group, had that big gap down on its earnings report, was able to bounce and fill that gap and then some, but then has been in a really sharp downtrend since then. Had 1, 2, 3, 4, 5, 6, 7, 8 consecutive down days, put in a really tight bull flag, bounced back up into its 200-day just about, and then 2 harsh down days. Yesterday you had a gap. It didn't really accelerate to the downside yesterday, but today you got that acceleration to the downside. Now this pivot low here around 54.63, that's going to be a last stand type of area for Triple D, because if it breaks that, there's sort of 2 pivots from there. As you can see, this tail from back here in late October. If it breaks that, you could see it get below $50, and that area hasn't been seen since last October. And then you take a look in the context of the chart how far this came. This looks a heck of a lot like a head and shoulders pattern to me. You have a left shoulder here, a head, a right shoulder. Breaking that would be that measured move would take it to below 0, so you might not get the full measured move of the pattern, but you could definitely see this come back to reality, as I think this sector got a little bit ahead of itself. It's an interesting technology. It sort of reminds me of what happened with the solar stocks back in the early 2000s, late 90s. And I'll give you a peek at a few other 3D printers before I'll take a look at the solars, and I'll talk about their past and their present. But you look at Stratasys. This one's actually been holding up better recently than Triple D, but it got a really harsh down move today. I just couldn't overcome the weakness that we're seeing from some other names in the group. Now it's right around its 200-day. Be interesting to see next week whether it accelerates below that 200-day. If that does happen, you'll see it challenge this pivot low here at 102.21. If it breaks that, the next support isn't down here until the low to mid 90s. So definitely interesting there. XO&E was the one that had that weak earnings report. Big breaking key support level today is XO&E, definitely looking not very healthy at all. And I talked about the solars. The solars are very interesting right now because you're seeing a lot of divergence within that group, and FSLR has been the one that's really emerged over the last several days after a really strong earnings report. But first what I'm going to do is take a look at the solars, and maybe this is the trajectory that 3D printers follow. Like I said, it's a very exciting technology, 3D printing, and so was solar energy when it started to gain prominence. But as you can see, back in the mid to late 2000s, solar energy, people thought it would be the next big thing. We could get rid of coal energy. We wouldn't have to take all the risks of nuclear energy. And you saw these things go parabolic. FSLR was a $300+ stock back in 2007, 2008, but obviously came back to earth in a big way. So in the context of the chart, this recent resurgence isn't all that significant, but obviously if you bought recently, it's significant to you because you've seen a 30+% gain over the course of 4 to 5 sessions. And as you can see here, FSLR was actually a laggard in the group and broke above this key resistance area after the strong numbers here on March 19th. And then it's continued to hold higher, and today open around flat to slightly negative and continued to surge, which is very constructive. Right now, I don't think you can buy it. Obviously, the 8-day is very far away. It's very extended from its short-term moving averages, but the solar sector is exciting to me. I think there's a lot of technology breakthroughs happening. Cost structures are going down, and First Solar is the biggest name in that group. Maybe not, if you're looking for a small cap name to hit a home run on, maybe FSLR is not that one. But I think, given the fact that it's one of the biggest, I think it's definitely one that you should keep an eye on. But there are some divergences, like I said, in the group. SPWR, not SPWR, I was going to look at SCTY, sorry. SCTY is heading in the opposite direction. It's an Elon Musk stock. He's the chairman of the board. He doesn't have as much say in the day-to-day operations as SCTY as he does in Tesla, which is something I think to consider. But he does have a say. He's the chairman of the board. So if you're looking potentially to be in the solar sector and you're looking to buy a dip rather than chase strength in FSLR, maybe this is one you look to identify some support levels. But it is in a little bit of no man's land right now. Obviously, the 200-day is very far away, but it's broken below the 821 and 50-day. Maybe an area to look at is support down here in the low 60s. This pivot is down here, 61.17. That's still a few percentage points away, but like I said, if you're looking to buy weakness rather than chase strength, maybe SCTY is when you look at. They have a little different business model than something like FSLR. They actually rent solar panels as opposed to selling them, but it's just interesting to see the dynamic there. SPWR, just giving you a look at a few other charts. TSL, this is one of the Chinese names. YGE, also acting weak recently, where you've seen FSLR really perk up. So yeah, just very mixed action in the solars, but overall a sector that I think is very exciting, sort of coming back on the map after falling off big time after a big run in the mid to late 2000s. Sort of in the same way you're seeing the 3D printers got a little bit ahead of themselves, falling off the map a little bit. Maybe their time will come, but you're seeing things unwind there a little bit. And when you see things unwind that quickly, like we're seeing in the 3D printers, it can lead to things like margin calls. It can lead to some damage, especially when you have hedge funds chasing performance like they probably are now after maybe underperforming a little bit in 2013. You have the chance that people are a little bit too levered up, especially in fast-moving names like 3D printers. Anything can happen there. And just overall tech, high beta tech, really showing some concerning signs. Usually in a rising interest rate environment, which is what we have with the Fed tapering, with Janet Yellen talking about maybe raising rates as soon as 6 months out, usually you see tech and risk assets like small cap stocks perform best in that environment. But today you actually saw that flipped on its head. And the stock market does often look to build consensus in one direction and then punish all those people who chase that consensus and who are part of the herd. Maybe that's what we're seeing right now in terms of that dynamic with interest rates. And you just look at TBT or you look at the TLT, for example, you'd think that, yeah, they continued on their tapering schedule. They're talking about raising rates. You'd think that bonds would be weak, but no, bonds were very strong today. TLT traded back up into its 200-day moving average. If you like to look at the bearish ETF that's 2 times multiplied, it's 2 times ultra short the 20+ year Treasury bond, TBT acting really weak. And if it gets back to the $68 area, If it breaks that, it could be lookout below for TBT. Obviously, doesn't necessarily follow the narrative, but I think the market is a leading indicator. People were looking for this type of, they were looking for tapering, they were looking for talk about raising rates, and that's why you got this big down move in January. People were trying to get ahead of that move, and now that that reality is here, it's sort of like you buy the initial speculation and then you sell the news. That's sort of what you're seeing, the type of situation you're seeing in TBT right now. So just something to keep an eye on there. And then, for example, utilities are a sector that often perform worse in a rising interest rate environment. That might play out over a longer time frame. Maybe they're trying to shake some people out right here, but you saw utilities were very strong in the morning today, and they did reverse to the downside like the rest of the market, but rather than finishing with decent losses, the utilities basically finished around flat. So that was very interesting to see today. Maybe it was a quad witching a situation that came out of the fact that we had quad witching and they were trying to cause some max pain for people. Who knows? And this will be a trend that I'll be watching next week to see if bonds and utilities, for example, continue in this direction and continue this dynamic. And then, like I talked about, tech, high beta tech names have been very weak. These names that have been momentum leaders, Amazon has been weakening, over the course of the past 2 months after a weak earnings report, but it was one that looked like it might be in the game for higher prices, but put in this big sort of topping candle here, a few days of choppy action, and then some really big downside today, breaking below its 8 and 21-day moving average. You look at Google, nasty. This has been a real leader, and it's been very resilient. It did bounce off its 50-day again, but today, a big engulfing type candle, broke below its 8 and 21-day, and one that's looking a little bit tired as well. You look at a Netflix, if I can punch it up. Netflix, extreme weakness today. This has been listed as a short on off the charts, so we noticed this rounding top type pattern forming. We noticed some of the rotation coming out of tech, out of these leading tech stocks and into things like banks and stuff like that. And so we listed this as a short. It was definitely one we have a tight stop on an idea like this, but it triggered the short entry, and then after bouncing yesterday and closing well off its highs, big time down move today, closing on its lows, closing below the 8-day, closing below the 21-day, closing below the 50-day. So this one definitely looking like it's going to weaken, or it has been weakening. Looks like it could weaken further. Watch the $400 area for potential support if you're looking for some kind of reversal trade there. And then even Tesla hasn't really broken down, but it's sort of on the brink right now. Today it was weak, closed below the 8 and 21-day. You have this gap here that could get challenged, and as we've seen, Tesla can be very volatile in both directions. It had a big pull-in. I'll go to the weekly chart, get a better look at it. Had a big pull-in after it topped out here around 195. Big pull-in, but then obviously has surged since then. But you can see volatility in both directions in Tesla, and I think it wouldn't be the end of the world to see it pull back a little bit. And these momentum names are seeing some money rotate out. And then you talk about social media, Facebook looking a little bit suspect. We've talked about maybe a tiny little head and shoulders pattern forming. It's not the cleanest chart in the world in terms of the head and shoulders pattern. Actually showed relative strength today by finishing positive, but if you continue to see money rotate out of tech, Facebook, you could see some profit taking there after a really big start to the year. And then Twitter, looking very suspect. Also showed, I guess you could say, a little bit of relative strength today, but overall it's just been dead money. Hasn't really been moving much at all. This $50 area is the area that everyone is watching for a potential breakdown. Maybe you could take a little bit of a contrarian view. Maybe some people will be looking to short this thing down through 50. If we do get some sort of acceleration down through 50 and maybe multiple down days in a row, this one I think could be ripe for some sort of reversal. After that big run late last year, it shows there's demand for it. There's demand in the social media sector. WhatsApp, $19 billion purchase price, the bullish action you've seen in Facebook. It's a hot sector. People are a little bit iffy about where Twitter fits into that long term, and talking about the world of social media, whether it's going to stack up and be one of the ones that has a long life. But it's one that with a short float, all it takes is a little bit to get it going, and I think it's building some short interest as well. So I think it definitely could be ripe for a squeeze with some sort of capitulation down to that $50 area. And then Apple. Apple, talk about dead money. Apple is the epitome of dead money right now. Like I often say, I almost feel guilty for talking about it on the daily recap because it reinforces people's obsession with it. But what you're seeing now is Apple coming to the apex of a wedge pattern. You're seeing a very clear downtrend that we've been talking about. It's tried to break above it multiple times, hasn't been able to. And then you see the uptrend here. It's going to have to resolve this wedge pattern within the next week or so. It's coming to the apex, so what you can see, you can just take a very neutral view on it. If it breaks below, maybe you look for a move down to the 200-day. If it breaks above, maybe you look for a move back up to pivot highs here around 575. But it's coming close to an apex and could resolve, so maybe it's worth keeping an eye on. And something I talked about a couple weeks ago when I was on the morning call with Scott is that when you see leadership breaking down, the indices holding up, and money rotating into some really low-quality stocks, I called it the flight to inferiority, that's often another red flag that you could be nearing the end of a bull market cycle. And we continue to see some weak names be some of the stronger names during today's session. And just a few examples of that. You look at something like JCPenney's wasn't really strong today, but it's holding up. You look at something like WLT, bouncing a little bit, showing some relative strength today, not breaking down with the market. You look at something like BBY perking up, Best Buy, huge gap down. This thing has been absolutely hammered after a big bounce back over a multi-year basis. But there's not a ton of money rotating into those, but just some examples of things that are getting people's attention and acting a little bit stronger. You're seeing something like Zynga break down. So overall, you're seeing just very mixed action in tech. You're seeing weakness creep into tech. You're seeing some low-quality stocks actually hold up better than what we deem the higher quality stocks. So just some interesting notes there. The banks. The banks have been one of the reasons why the market's been holding up well. We've talked about money rotating out of tech, and the banks have picked up the slack and been that sector that money's rotated into that have allowed the indices to hold up. Look at Bank of America. It's been the strongest one, but a big nasty reversal today. Opened higher, looked like it might want to continue to show relative strength, but instead, wasn't able to push higher at all off the open, close on its dead lows. When you see a type of candlestick like that, that tells you there was big time commitment in the direction of the candlestick. There was no dip buying interest late in the day or anything like that. Definitely not the most bullish sign, but it is just retesting this breakout area. I think overall the banks, after a nice recent bounce, are due for a little bit of rest, due for a little bit of consolidation. But if you are going to trade them, look for the higher quality names, the Bank of America's. Wells Fargo actually finished around flat after opening sharply higher, so this is actually my favorite name among the group. Nice dividend, a lower risk-taking type of institution, which is always good. But you look at something like Goldman Sachs, if you're looking to short bounces on something, like I've talked about before, maybe a little bit of a pairs trade on a Wells Fargo long or a Bank of America long and a short Goldman Sachs, something like that. JP Morgan even been acting a little bit better. Morgan Stanley even been able to bounce a little bit, but Goldman Sachs acting very weak among that group. And just a few quick hits of names that you might have heard me talk about here before. Some of them are value type names. Some of them are more speculative type names that have caught my eye. GLW is more in that value category. It sort of blends the two, and I love when I can find a stock that blends both value and an exciting story, an exciting narrative, the potential for higher growth. And that's what you have with Corning. Corning is a company that does LCD displays and things like that traditionally, but they also do Gorilla Glass, which is the glass that you have on your smartphone covers, your screens, on tablet screens. Apple uses it, Samsung uses it. They're in a more direct partnership with Samsung now, after Samsung took a stake in the company. But if you take a look at the chart, it's been acting extremely well. When I first started talking about it, it was down here in out of this lower level base around 13. That's when I personally got involved in the story. It was a little bit of a laggard type situation, but one that I had read a lot of things that I really liked about it, and I liked the valuation, and that's led to a really nice move higher. It's not one that I've been tick trading or day trading or anything like that. It's not the best day trading vehicle, but it's one that long term, yes, it does pull back a little bit during market corrections. It is decently correlated to the broader market. But yesterday, as you can see, really nice relative strength. Closed a little bit off its highs, but then posted gains today. So love the relative strength Corning is showing. And even after the big move over the time span that I've owned, that I still love this stock and still think it can head higher. And then actually, one that I really like as sort of a hedge for Corning is that you have Apple in a close relationship with GT Advanced Technologies. GTAT builds the material that is on the cover of the Apple camera, or the iPhone camera. So there's a little film that covers the iPhone camera, and it's a very strong substance that people speculate potentially could be the cover of iPhones and the cover of iPads and things like that. But right now, that cost structure just doesn't work for Apple. But it is getting a lot of interest, getting a lot of upgrades on Wall Street, and it looks like it might have a really good future. They got a bunch of funding from Apple to do more research on there. It's called Sapphire is the material. And like I said, getting a lot of positive attention from Wall Street, and the price action is supporting that. So if you're worried about Sapphire taking over for Corning Gorilla Glass and you own Corning, for example, I think you should also own GTAT, and acting really well. A little bit hard to chase now, a little bit extended, but even if you get a retest back into this $18 area, depending on your time frame and what you're looking for in the trade, could be a compelling area because this is a very strong stock that's been riding its 8-day. Hasn't even tested its 21-day since back here in early February. So definitely a name to keep an eye on. I think it has a big future, and more of a speculative type name rather than a name like Corning that pays a nice dividend. But I think owning those two stocks together could be very lucrative. Microsoft, same type of situation where it's become a value name. It's a dinosaur of tech, pays 3% plus dividend yield, but also you have the new CEO taking over, a fresh, innovative type approach. They're building Microsoft Office for the iPad. They're not focusing so much on hardware. They're doing what they do best, which is software and Microsoft Office, which will continue to be their bell cow. And you saw a really nice breakout there. We mentioned it in Scott's 2014 predictions, or his 2014 Outlook report. And it got that breakout. We talked about a reversal at 35. It was sort of like clockwork about what we talked about. It doesn't always play out exactly how you think it's going to play out, but sometimes it does, and that's what worked out with Microsoft. Really nice multi-day breakout. Needed a rest today. Was extended from its 8-day moving average. I would definitely love to see some consolidation here above 39 in the $40 area for a potential continuation type move in Microsoft. Another one that I really like. And yeah, those are just a few of the names that I like longer term. Maybe I'll start to incorporate a few more value type names in here. I think a lot of our audience is people who look for momentum type stocks and quicker moving type stocks that can give you a little bit more instant gratification. But as you're seeing in the market right now, sometimes looking for instant gratification can punish you a little bit. And yes, you are seeing some small cap names in the marijuana industry and small cap biotech names perking up and potentially giving you winning lottery tickets. But over the long term, I don't think that's necessarily the best approach to the market for everyone. Some people can make it work for themselves, but the most important takeaway, and Scott talks about this as well, is that you just have to find the approach that's right for you. If you think you can be a day trader, if you have 24 hours or 12 hours during the day to sit in front of your computer screen and day trade, then maybe you can do that. Maybe you can make it work for yourself. It's a very difficult thing to do. Swing trading is slightly less difficult in my opinion, something that is getting more difficult after huge gains over the last few years. 30% gain in the S&P in 2013. We've seen things be very choppy so far in 2014, and the market looks overall a little bit tired. You're not getting that trending type action that swing traders love, so that is getting a little bit more difficult. But if you're a longer term investor, you always look to put money to work consistently every single month. You don't worry about fluctuations in the S&P and things like that. You're not even worried so much about the indices, to be honest. You're looking for quality companies that make money, that are solid companies, pay a nice dividend, they do right by their shareholders. And then if you can find opportunities like a Corning, like a Microsoft, where you think you can get a combination of growth and value, that's exactly what you want. That's my sweet spot, and I think that's a great long-term approach as well. But know your time frame, master your time frame, be true to yourself, your personality, so you can sleep at night and take care of your financial future. But this has been John Darsie here for your daily recap. Enjoy the rest of the NCAA tournament. University of North Carolina Tar Heels go Heels tonight, play Providence at 7:20. I'll be looking forward to that. But like I said, now that Duke has lost, emotionally I'm sort of playing with the house's money at this point. But hopefully the Heels can make a run, and whatever team you root for, good luck to them. We'll see you back here on Monday morning for the morning call.